Subscribe to this channel.
Assalamualaikum warahmatullahi wabarakatuh. My name is Cipta Sukma Wardana, student number 22411177. I'm from management class 20B. In this video, I will explain the material from the financial management course. Let's just get straight into the discussions. Slide number 1. Understanding financial ratio analysis. Financial ratio analysis is a powerful tool in assessing the financial performance of a company. It compares numbers from the financial statements to produce meaningful insights about the organization. Let's explore these ratios in more detail. Slide number 2. Purpose of ratio analysis. Point number 1. Monitor financial health. So by analyzing key ratios, investors, management, and other stakeholders can monitor the financial health of an organization and its potential for growth. Point number 2. Benchmarking. Ratio analysis help compare the financial performance of a company within the industry and against standards benchmark to identify strength and weakness. Point number 3 is business decision. Next, slide number 3. The methodology of ratio analysis. Step 1 is extract relevant data from the income statement and balance sheet to prepare financial statement. Step number 2, calculate the ratio by dividing one figure in the financial statement by another. Step number 3, analyze the trend of ratio over time and benchmarking them against industry standards. Step number 4, interpret the ratio to identify area of strength or weakness in the organization in the informed investment or business decisions. Next, slide number 4. Jenis-jenis rasio keuangan. Point number 1, liquidity ratio. Measures a company ability to pay off short-term liabilities by comparing current asset to current liabilities. A current ratio, quick ratio. Point number 2, solvency ratios. Solvency ratios measure the ability of a company to meet long-term obligations at debt to assets ratio, debt to equity ratio. Point number 3, profitability ratio. Profitability ratio is measure the profitability of a company in relation to sales, expense, and assets. at profit margin, return on investment. Point number 4, efficiency ratios. Efficiency ratios is measures how effectively a company uses its assets to generate income, its assets turnover, the capable turnover. Slide number 5, liquidity ratios, pengertian dan contoh. Number 1 point, current ratio. Current ratio is measure whether a company can pay off its current liabilities using current assets. An ideal ratio is 2 H/1. H current assets / current liabilities. Its current assets or current liabilities. Point number 2, quick ratio. A more conservative measure of liquidity, it includes inventories that may not be easily liquidated as current assets, inventories or current liabilities. Slide number 6, solvency ratios pengertian dan contoh. Debt to equity ratio is measures the proportion of debt and equity in the companies financing. It shows the long-term solvency of the company. A ratio of 1 means the company is balanced as total liabilities or total equity. Next, interest coverage ratio is measures the company's ability to meet its interest payments from its earnings, its EBIT or interest expense. Slide number 7, profitability ratios, pengertian dan contoh. Point number 1, gross profit margin is measure the amount by which sales exceed the cost of goods sold, expressed as a percentage at gross profits or sales. Point number 2, return of investment or ROI measures the return on investment made in the company in the form of dividends and share price appreciation at net income or total assets. Point number 3, return on equity or ROA is measures the profitability of the company compared to equity. So, how effectively the company utilizes shareholders' investment as net income or total equity. Return on equity, this shows how effectively the company utilizes shareholders' investment as net income or total equity. Point number 4, earnings per share or EPS is measures the net profit attributable to each share of common stock at net income or number of shares outstanding. Next, slide number 8, efficiency ratios. Point number 1, account receivable turnover is measures how often a company turns its accounts receivable into cash. A high ratio is preferred as net sales or accounts receivables. By number 2, inventory turnover ratio. Measure the efficiency of a company in managing its inventory. A high ratio is preferred as cost of goods sold or inventory. By number 3, asset turnover ratio is measure how effectively a company utilizes its assets to generate revenue as net sales or total assets.